I'm here today with Jim Thorne, Dr. Jim Thorne, the Chief Market Strategist at our firm, Wellington-Altus. Jim, thanks for joining me today.
Thanks for having me, Glenn.
I thought where we'd start today is just a bit of a reflection. You have shown a remarkable willingness to kind of take the non-consensus view. And I thought I'd just inquire, why is that? How are you able to do that? And why is that so important to your work here at the firm?
Well, Glenn, I think we have to go back about 20 years, 25 years when banks got into our business and really started to water down the type of intellectual property that we could discuss about. So it's really quite interesting for me just to be able to take the other side because, there's a bull case and a bear case. And typically, our competitors give a very pedestrian point of view on what the world is. And what we try to do at Wellington is basically take a different point of view. But let me be clear, Glenn, when we take the other side of the trade, so to speak, it's backed by facts. It's backed by economic theory. The fact that, our competitors really don't look at things in a deep fashion. It's a very cursory, very pedestrian point of view. And unfortunately, Glenn, things are a lot more complicated than many let out to believe.
Isn't that true? And so do you think that that is kind of a problem which infects the entire industry?
Glenn, I cut my teeth in the States, right? And I work for a Warren Buffett bank. But what I can tell you is the perception looking back into Canada is that since the banks have controlled our marketplace, the research, they become lazy, right? Because there is no competition. And other thing that I want to suggest is as a strategist, and I'm also like an economist, right? I find too often the position is filled by a bureaucrat who's more worried about not going against the flow. Sure. Whereas what we're really trying to do is help our clients achieve their financial goals, have honest discussions about topics, and maybe those conversations are uncomfortable. But Glenn, this business is really tough. And to position the portfolio correctly, we have to look at all aspects. And so we can talk about these things. And the freedom about being at Wellington is I can talk about these things. If I worked at a bank control, I may not be able to talk as freely as I'm allowed. Now, we're talking facts here, and we're talking economic theory here, right? And we're allowed to do that to get our clients to achieve their financial goals. And that's the main point.
I would totally second that because I think from my side of the table as well, there's something similar that goes on where there's kind of career risk in diverging too far from kind of the status quo. And so I think that part of my reason for joining here was just the idea of I felt we had an opportunity to do a better job for clients than the bank-owned firms. And by doing that, or by going deeper in different areas than the status quo, we could actually distinguish ourselves from the pack. And I think you've done that really brilliantly in the short amount of time that I've known you. And maybe that's a good place for us to kind of jump into an example of that. Maybe you could kind of catch us up. You're kind of being vindicated on your call for interest rates certainly in Canada and in the US, but you, by your own account, you took some heat for your position that the Bank of Canada was way, way, way behind. Catch us up on that. What did you see that you think your peers weren't seeing? And maybe take it a step further. Now that it looks like the US will be joining the party. Again, I think in your view, too late. But just give us a bit of a sense as to how you see this unfolding.
Sure. So, Glenn, I'm going to put my chief economist hat on, not strategist yet. Okay. So let's just review some stuff, right? We know how to solve inflation. Okay. We do not know how to solve deflation.
Right.
Okay. And the lessons of Japan, which China are going through right now, is that when you have extreme levels of debt and you raise rates too much, it is deflationary. Right? Yields in China are dropping to historic lows. Yes. They have cut rates. And guess what, folks? the real estate market didn't rebound. COVID hit, and Jay Powell invoked a very rare section of the Federal Reserve Act, which is Section 13.3, where he created money out of thin air and mainline injected it into Main Street, bypassing the banks.
Right.
Now, Glen,
that's a key distinction, right? That's a key distinction.
It is a massive distinction, because that's created all the inflation when we shut the economy down. So we just took all that money. It's, folks, in a normal environment, which we are going back into, it is the money-centered banks that create money through lending. What we just went through with COVID was a historic, a unique. We're never going back to it. And so the risk...
It's like World War II, right? It's kind of the size of World War II.
It is. And that was Glenn, that was the last time it was used. The last time that 13.3 was used is that what happened is the Federal Reserve became subordinate to the Treasury and financed the war. Well, what did we do here? The Federal Reserve became subordinate to the Treasury, and we financed a recovery
war
of
on COVID. Yeah.
And so that's why I look at our economy now is like a wartime-like economy. And it has to evolve back into a peacetime economy. And when that happens, you have to go through a period of fiscal consolidation where deficits of 7% are unsustainable. Debt to GDP of 125% unsustainable. Right. So, Glenn, we're walking into fiscal drag. We're walking into where a pullback of government spending slows economic growth. This is just basic economics. And it's exactly the same thing that happened in 2007. So we're going into a period of lower for longer of interest rates. You can call me profound for saying that, or an agitator, but I would counter with you, Glenn, what the heck is Bay Street and Wall Street talking about?
Yeah. Well, because I was just about to interrupt to say that lower for longer is, of course, the exact opposite of what we've been hearing for so long, higher for longer.
Sure. And so it's exactly what happened after World War II. We had 3 years of 10 plus inflation. We cut government spending and it dropped off. We're going into this adjustment period, right? Let's be honest. Tiff Macklin knows this. Jay Powell knows it. They're smart people. Okay. I read his speech. I know exactly what they're saying, right? They're freaked, right? They went out. Jay Powell at Jackson Hole said the labor market is looser than it was in 2019 when he was cutting Fed funds rates below 2%. As you get fiscal drag or the lack of government spending, and what happens when that check does not get filled with another check? It stops. Interest rate cuts take at least 18 months to get through. Okay, that's first quarter of 26, Glenn. What is the momentum going to be like between government spending coming down and them trying to re-accelerate economic growth from the private sector? Well, I would suggest the Americans have a better chance because they've got innovation, they've got AI, they've embraced blockchain. We don't have a diversified economy up here.
That's right.
Right? And the controversial thing that I said, I know this is profound, it's really profound, is that the Canadian economy isn't as diversified as the Americans is, right? Mm-hmm. Real estate and energy, and oh, by the way, Ottawa doesn't think that energy and natural resources are a growth sector for us, right? Mm-hmm. Right? And I think the other thing, Glenn, because I lived in D.C. for 15 years through the financial crisis, the other interesting thing that I think Canadians really have to understand, how lucky they were to miss the pain, the real pain that came out of the global financial crisis.
GFC.
Yeah, it was because of good banks. The Canadian banks are the best in the world. I mean, I can hammer them about the fact of where they are in our business, and I love to compete against them, but they're the best managed banks in the world. And the other thing is that China had no debt. And after the global financial crisis, they went from zero debt to about 50 trillion in debt to basically build the Belt Road Initiative and build all this infrastructure. So
Right.
we missed the real pain. So what's going to happen is, Glenn, we're going to cut rates and people are going to realize that nothing happened. And that's what happened recently up here in Canada. Now the calls are 50 basis points. We got to get it down to what's neutral, or what's called R
Right.
star, right? The neutral rate, which is about, let's say, 2.5%. But let's be honest, Glenn, we got to go below that, right? And
Right.
we're
To
going to go
stimulate.
below.
Yeah.
The rates should bottom in 2026, right? Build your portfolio accordingly. Now, here's the difference, right? When we talk, Glenn, I say that to you. Now you can agree with me or disagree with me, but now you go build the portfolios for your clients.
That's right. Yeah. And this gives us a huge tactical advantage to be able to have even just that rationale in the back of our minds. Because frankly, let's face it. I mean, this has a lot to say about how the high dividend paying common shares in, like, what the opportunity in high dividend common shares in Canada are going to be, right? I mean, if rates are going that low, then that trade probably has a fair bit further yet to go. And so I find that very useful in my own practice. Now
the psychological thing that's going to be really interesting is the non-consensus view is that nothing's been fixed. That's our view, right? When they start to cut, people are going to think that interest rate cuts are a magic bullet and everything's going to be okay. It happened in 2007. So you're going to see this false rally in small caps and interest rate sensitive stocks and cyclical stocks because everybody thinks that a couple of rate cuts are going to fix it. Glenn, it's when they come to that realization, which might be later on this year or early next year, when folks realize that rate cuts aren't going to fix what we've got.
Yes.
Right? And that's when I think you're going to see a rapid deceleration of interest. You're going to have to cut rates further and quicker than folks believe. Right?
Right.
And that's okay, right? Because we're talking about this. But think about this, Glenn. We were talking about this 3 years ago. And people were like, oh, this is the 1970s and inflation is permanent. And what? You got debt. You've got innovation. You've got globalization, and you've got demographics, all deflationary forces. Yes. Where is this new inflationary era? Right? It's a post-World War II era, not the 1970s. And that's our view, and that's our roadmap.
Yeah. So then, given that, you've been early on the AI call. I mean, one of the things that ultimately pushes in deflation is technology, right? Obviously, this isn't a new story anymore. When you first started on it, it was new. It was non-consensus. It's highly consensus now. Tell us where you see us in that. If that was a ball game, what inning are we at? Where do you think that is going, and what's the opportunity for people who have maybe been underweight or just market weight on this to date?
So when you look at macro, right, or innovation, the easy part is identifying the theme.
Mm-hmm.
The hard part is identifying the timing.
Sure it is.
And so when ChatGPT came along, I was driving to Montreal to visit a couple of our teams in Montreal, and I was listening to CBC radio, and they had these experts on, and they started, and I went, OMG, right? Oh my God, this was going to happen. So I experienced the internet bubble. And what I can tell you, it was the psychological evolution of people saying it's a scam. No one's going to use it, yada, yada, yada. Only criminals are going to use it, and it's the same cadence as what we're dealing with now with AI and Bitcoin. So, and people traded out of it. And so what I would say to you is data suggests, going back decades, that if you look at the performance of the stock market, it really comes down to about 2.49% of the stocks.
Of the stocks.
Let's make that 3%.
Sure.
Okay? And let's say it's the S&P 500. 3 times That's 15 stocks.
15 stocks. That's right.
That's 15 stocks. So when you find a winner, you hold on to it. You never sell it. Once you identify the winners, and once you know that there's a very small portion of stocks that generate over the long term all the performance, then when you find the winners, so this is the biggest theme in our lifetime, and it's going to generate economic growth until the end of the decade. Amazon, if you just would have bought it and not touched it, you converted 10 grand into 22 million.
Yeah. Yeah.
So the objective here is to find the winners. I understand we have to have a diversified portfolio and all that type of stuff, right? But really, the funny part is when you look at Warren Buffett and you look at his portfolio, it's highly concentrated. So what I would suggest and what I keep saying is buy the winners. Identify the winners. What are the winners? What are the high quality names with the best business management team? Look, NVIDIA is trading under a peg of 1.
This is the most crazy thing to me. Go ahead, tell them what the peg is.
So which is a relationship between growth and the price earnings ratio.
Right.
Anytime you get a semiconductor, a leading global company with a peg less than 1, I don't know, Glenn, buy it. If you find winners, you don't sell them because they are such special animals that you just never ever want to get rid of them. And then once you get, if that switch goes off in your head, there's a lot of clarity, right? Because you don't have to go and is you bang you bet you're going to be the next NVIDIA. Well, no, not for this cycle.
Yeah.
Right? Is there something that's going to replace Walmart? Nope. Costco? Nope. Lilly? Nope. In oil, right? Oil and gas. Buy Exxon. Winner. Technology company. Leading edge. I don't care what the price of oil is. I don't care. They're the 100 killers, high quality, right? And so if you build your portfolios that way, knowing that 15 stocks generate all the return over the long run, the treasure hunt, which I call, is a lot different, isn't it?
Sure it is. Sure it is. And I'll just double click on something that you raised there. I mean, a lot of what I'm hearing about is the concern about, well, where's the revenue? I mean, there's been so much expenditure. Where's the revenue that's being generated from AI? And I'm sure you saw the recent Amazon report where their system is called Q, and they estimated that 4,800 years worth of coding they were able to do with this AI, and Walmart had similar kind of impact. So this is we're already seeing some of the low-hanging fruit being picked by these huge companies that are probably, it's probably true to say that they are all tech companies at some level as they kind of integrate this. So I'm with you for the record. I think that we are still in the early days of this new compute paradigm. I hate to use that word, but I think that's what's going on. And it's probably the most significant opportunity that I will see in the remainder of my career is kind of the way I'm thinking about it.
When you think about the old computing infrastructure, so for your viewers or people listening in, have you ever bought a home where you wanted to renovate it and you had to go in and you had to rip out all the wiring and replace it? The computing infrastructure of the global economy was designed in 1947 by a gentleman named Johnny von Neumann when he went to the University of Pennsylvania in the summer, and they devised this CPU-centric infrastructure architecture. That is now being replaced by a GPU-centric architecture. Everything has to be rewired globally. Everything has to be rewired. Okay, so if you're sitting there and you're Amazon or Walmart, pick a company and say, we have all this data and we want to go AI, but sir, our server farms are CPU centric. We got to buy a GPU centric architecture. Well, who makes the leading GPU? Oh,
NVIDIA.
Oh, NVIDIA. Oh, every company has to do this or
That's right.
they die. They get
Mm-hmm.
wiped out. They have embraced AI. So you've got really smart management teams that have decades of evidence of them understanding the transformative nature of innovation and how they can better their business models. And so you don't have to believe me about it. Believe Amazon and believe Walmart.
Absolutely. Absolutely. Let me change directions here for a bit. So let's move away from the tech side of things. As much as I think you and I could probably camp out on that for the rest of the day. But lately you've been writing about, and I've also been writing about for my clients, the breakout that we've seen in gold. We've seen as the consensus is that it's not going to be higher for longer for interest rates. We're seeing the US dollar begin to decline. And that's, of course, pushing commodities higher, including gold, particularly Bitcoin to varying degrees as well. So tell me a little bit about how you see the case for commodities, maybe as a barbell. Like how are you seeing that in your work?
Well, it goes back and it's all there in history, right? So in Bretton Woods, coming out of World War II, John Maynard Keynes went to this guy that was negotiating for the Americans, Harry Dexter White, and he basically said, if you make the US dollar the medium of exchange of the global economy, then you're going to go by you're going down the same path as the Romans and the British Empire. Okay? Remember, the British Empire was the empire where the sun never set. Mm-hmm. And he says, what's going to happen is you're going to go from a creditor nation to a debtor nation, and they're going to devalue their currency against you. You're going to have a decline in the standard of living. You're going to get a rise in populism. This is where we are right now. So we got debt. We got in the United States debt to GDP. I don't know. I say not 125% because it's a round number, but it's somewhere between 122 and 125, and deficits of 7%. Glenn, they need to refinance that. And they can't refinance that at 5%. The math doesn't work. It's back of the envelope. It's basic arithmetic. They got to get interest rates down, and they got to get the value of the US dollar down. Gold or Bitcoin. Bitcoin is the more pure way of playing this because there is no supply response to higher prices.
That's right.
Right? With gold, so I had a call for gold to be 2,500 by the end of next year. So it reached my target early. Okay. Mm-hmm. So where do we get to now? What is the unique aspect of gold is now that people realize what's going on and gold is above 2,500, hanging around there, what's going to happen with the gold miners, right? You're going to get a supply response, right? Mm-hmm. Gold miners are going to get capital. They're going to drill, baby, drill. More gold is going to come onto the market, right? So I love gold. This is the perfect environment for gold. Right, we could have a bull run in gold like we did in the in the 1990s and in the 1970s. But the pure way of playing it is Bitcoin.
Yes.
Right, because we have never seen an asset class that does not have a supply response to higher prices.
Right.
Oil's got it, uranium's got it, copper's got it. Right, you get the price. Silver's got it. You get the price of silver high enough. There's mines everywhere. Same thing with gold. There's only 21 million Bitcoin. It's almost all mined. It's becoming an asset class, and I think it's going to become the payment rail. Right, but what it really does is it introduces the blockchain technology into society, and folks, the internet that we based our first iteration of the digital global economy on was never designed to be the backbone of the global economy. So in other words, it was never designed to be able to transfer money digitally. So now you've got AI where basically you're going to empower robots and it's just going to go. And what's the payment rail? And they're going to marry the two together, blockchain and AI. And I would suggest to you, there needs to be something in blockchain where robots can transfer value.
Mm-hmm.
And right now it's Bitcoin. This is as big as taking water, applying heat to it, and generating electricity. We are now taking data and we're turning it into intelligence. I can't explain how profound this is, how fast this is going to be, right? And unfortunately, Glenn, going back to the 1990s, we had a couple of horses in the race up here. Well, you're in Canada, right? You in the 90s, you had Newbridge Networks, you had Corel, right? It was a hotbed. We in Canada participated, right? Bell Canada and Nortel helped develop the communication industry.
Right.
We don't have that now. And the fear is, according to data, that the average Canadian has 53% of their RRSP assets in Canada.
In Canada.
And if, Glenn, you and I if we were outside of the United States running a global macro fund, we might have two.
Two, right.
Maybe three.
Yeah.
So Canada is overowned, and everybody in the world knows it's called the legendary home bias, right? But we're in front of a technological wave that is going to, think about what you said about Amazon, right? Look at all of those workers, those high-tech knowledge-based workers that are going to get laid off, right? You don't want to be a coder anymore, do you?
No.
Right.
No. What is it? 2 years and they've solved coding. Right?
Yeah.
I mean, it is so, we are at such an early stage of this, and it's already transformed the prospects for the whole software development industry entirely. And I'll come back to, I'll marry those two ideas, and you kind of did it as well, but the issue of the commonalities between gold and Bitcoin are super interesting on a stock to flow basis too. So, you made the point that what happens when prices go up for gold? Every junior in the world starts doing share offerings, they attract capital, they increase supply, and ultimately the price comes back down. Whereas with Bitcoin, since the supply is algorithmically determined and we're coming up to that halving event, the supply, the stock to flow, is actually decreasing over time, right? So the stock to flow is actually increasing. We have more stock relative to the flow of new issuance. And so that's another reason that I love both gold and digital gold. But the math behind the digital gold is in many ways superior to let's call it analog gold. And I think
it's interesting because for folks that are watching, just do your own research on it.
Yeah.
Because the more you do, the more if just do your own research on it. But the way that I would say, the way it goes, if there are families in New York City that if an apartment on the Upper East Side or West Side comes up for sale that has a view of Central Park, they buy it. And they buy it and they never sell it. And they hand it down from generation to generation. Folks that understand the debasement of fiat currencies and the propensity of politicians to spend will never sell Bitcoin.
Right.
Because it is a hedge against fiscal irresponsibility. And we have gone through an era with Ottawa and Washington, D.C. embracing this theory called modern monetary theory that says deficits don't matter.
Right.
Really? Well, this morning, the new Prime Minister of the United Kingdom came out and said the budget that they are going to have to implement is going to be painful.
Right.
Glenn, there is no free lunch. There is no free lunch.
Well, and here's another one. Here's another instance of you being ahead of the curve, right? Because you've been cautioning about a Liz Truss moment for North America for months now. And this might be a good point for us to kind of draw the conversation to kind of a culmination here. But as we approach the kind of the madness of the U.S. presidential election season, and having your view that from going from 7% deficits, we need to get to some kind of fiscal drag where we kind of right size that in a proportional way. But recognizing that we've got two different campaigns in the U.S. and two different visions of the future. Riddle for me what your views are on the election, and maybe you could pull that back to, you've talked a fair bit about 2026 and the kind of the presidential cycle and longer term cycles, and how do you kind of proxy the U.S. election risks and the near term outlook moving into that kind of 2026 timeframe?
Sure. So as an investor, I want to be politically agnostic.
100%.
I want to look at policy. We've gotten to the point where even the father of modern monetary theory, Warren Mosley, has basically said that his theory has been hijacked by the progressive left. Okay? Right? His theory about deficits don't matter. Well, he says, he's on the record saying that, yeah, well, that held when they didn't spend like drunken sailors. Okay? So to me, it's not who wins, it's their policies, and we have to figure that out in the early next year. But let me be clear. There was I grew up in Canada, and I remember this old commercial in the 1970s, Fram oil filter, and they say you can pay me now or you can pay me later. Well, here's the point. And this is a tail risk that I am concerned about, and I say it in my next piece that's coming out. Look, if they do not come back, either Trump or Harris, whoever wins, and they do not come out and give lip service to the deficit and debt, okay, we're going to have a financial crisis on our hand. Because here's what's going to happen. You mentioned Liz Truss. Liz Truss did not listen when she was the Prime Minister of the UK, and she put through a mini budget that disregarded the concerns that the credit markets suggested to her. She said, let them eat cake, and the credit market was the Lord High Executioner, and she lasted 45 days. Well, I'm not left or right. So it comes down to this. If they don't deal with the debt, we're going to have a financial crisis because the credit markets will make them deal with it. And we could have a 1987 crisis on our hand where the credit markets and the currency markets force the Americans to deal and the global economy to deal with the US dollar. Okay? That is the tail risk, right? Yes. So right now, at least from the policies that I am seeing, and it's fluid, I don't think the Democrats understand. And they're coming through with that MMT policy. Mm-hmm. So what I'm suggesting, Glenn, is, one of the things that we don't know about is Trump's trade policy. And when Trump got into power and he implemented the tariffs, we had an 18% correction in the stock market.
Yep.
And I would suggest to you that late 25, early 26, he's going to implement a policy and there's going to be a correction. I would suggest to you between now and the end of the year that the stock market has a really good chance of finishing between 58 and 6,000. And Glenn, when we came into this year, my target was 54 and I was alone on the island. Okay, now everybody's hanging out.
Yes.
58 to 6,000. I think by the end of next year, there is a good shot that the S&P is going to be between the range of 6,500 to 7,000. But here's the nuance in all of this. I think we're in a period of time where the Fed needs to cut rates. They're going to start communicating that they're going to have to cut rates faster than you expect. And there's going to be a widening of the breadth in the market where people are going to go, happy days are here again. Right. Everything's going to go up. All the junk that's been shorted is going to go up. We're going to have a dash for trash. And then by the early next year, people are going to splash cold water on their face and go, wow, the economy really isn't responding, right? Think about what's happening up here. And the breadth is going to narrow again.
Narrow once again.
Narrow once again until the end. And those stools that are supporting the S&P will have to correct, and we'll have to work through that from 26. I think interest rates bottom in 26. I am bullish to the end of the decade. But I think, and let me be clear, folks, and Glen, if I am right, and this is where we talked about it earlier, I am comfortable being wrong.
Right.
I am not God. Right? In behavioral finance, which I studied when I was a PhD student. Here, let me give you a little story. What we need is a narrative, a map. Kahneman and Tversky talked about in their white paper of these mountain climbers that got caught in the French Alps during a blizzard, and they found their way to one of those safe houses. And 5 days later, they got rescued. And the rescuers said, "How did you get here?" "Oh my gosh, this is a miracle." He said, "We had a map." And they showed him the map, and it was a map of the Pyrenees, not a map of the Alps. And they go, "Yes, but we had a map." And so what we want to do, and what we do at Wellington, is we talk about these things. We are setting forth the roadmap. We know we're going to be wrong, yes, right? But if we are already talking about what the late 2025, 26 looks like, and we have a roadmap, and we know we're going to have to adjust, that helps us in terms of managing our portfolios. And so we're not reactive, we're proactive. And
right.
Too many people in this business are reactive to what they see on TV, right? I want to be, and this is why, my job is to be 8 months to a year ahead of everybody else. That's my job. If I don't do that, I have no value whatsoever, right? So I've just painted out the signpost, and I would suggest this time next year, Glen, when the S&P's of like 6,700, and everybody's saying, "Oh my God, happy days are here again," I'm saying to you, raise cash.
Right.
Get defensive. Buy low volatility stocks. The numbers aren't in our favor, and that's what we're doing now. And we adjust. And then this time next year, what are we talking about when everybody's freaking out on TV? We're talking about, what do we want to do in October into July in 2026? Do the banks do the banks get out of the penalty box? Can they start creating credit? Is there new leadership? Where are we in AI? Are there new AI names? Has the chip play been played out? How does this look to the end of the decade? But the way we provide service and value to our clients is being 12 to 14 months ahead.
That's right.
And chatting about it and preparing. So go back to gold and Bitcoin. You don't want Bitcoin? You don't like it? Fine. I don't care. Right? Buy gold. Right? But don't complain. Bitcoin is the number one performing asset class this year.
That's right.
Double the S&P, killing the TSX, better than gold. Turn on the TV. Oh my God, Bitcoin. Well, it's up 50%. You're like, what? Right? So that's what I do. I'm comfortable being provocative and non-consensus because the majority of people in my business are reactive to the daily news. Glen, I'm already in the back half of 25.
That's right. That's right. And ultimately, I think that's a good note for us to kind of end on, because fundamentally, what we're trying to do here is bring value above and beyond a buy and hold kind of strategy, right? If it's implicit, the reason we have all these conversations, the reasons that we spend all the time that we do analyzing these things is because we believe that an active strategy should outperform a passive strategy. Otherwise, there's no point in doing it. And you're not going to be able to do that just casually. So I really appreciate reading your work. A quick anecdote I'll share is that you seem to have the same problems with boundaries on your time that I do. I recall us texting one Saturday night at about 10 a.m. and 7 a.m. the next morning, you were sending an email to the firm. So I know that you're constantly thinking about this. It's a passion of yours. It certainly is of mine. And I just wanted to take the opportunity to say thank you for everything that you do. And certainly thank you for taking the time today to bring us up to speed. And we'll do this again sometime in the not too distant future. So thanks everybody for watching. It's Glen Evans from Evans Family Wealth. Our family serving your family. Take good care.